All right, so let's begin the show. And it's the beginning of the new year and a time when you need to maybe relook into your investments, revamp or review your investment strategies as well. But what's in store for the markets in 2024? No, I'm not trying to make any prediction over here, but what's the sense and pulse of the market and world economics hinting towards? Let's decode all of this. Today I have with me Kalpen Parekh, MD CEO, DSP Investment Managers. Kalpen, good evening and welcome to the show. And first of all, a very happy New Year to you. And Kalpen, as we begin this new year, what would you like to say to those investors specifically who would be anticipating the same market momentum that they saw maybe during Diwali or during December, the Christmas rally? Past returns is definitely not a guarantee of your future returns in the market, and we all are aware of that. But then today, the numbers that we saw, 17,600, and even the mutual fund AUM has crossed beyond 50 lakh crores. So we have a good news over here. But then what about investor sentiment who might be expecting the same 2023 year, the same kind of market momentum and paciness?
Hi, Kavita. Happy New Year to you and the viewers. See, markets don't deliver returns in line with what our emotions or our expectations are. They are very random in the short term. And in the medium to long term, they reflect two things. They reflect the growth of profits and they reflect the price that you pay today. Is that price fair or unfair? So if investments are done in proper growth rate businesses, companies or economies and at the right price, reasonable returns can be made. And I think that is the simple rule. Short-term triggers like the industry crossing 50 lakh crores or SIP numbers rising or falling. These are, of course, some variables, but I, as an investor, personally don't look at these things. As an investor, we are here to fulfill our long-term objectives, our personal goals, beat inflation, earn superior returns, then our, build our purchasing power. And ultimately, equity as an asset class delivers that over a long period of time. 50% of times, there are chances that annual returns can be less than fixed income, and that is what the last 35 year history has shown. Now, which year will give that lesser return? No one can predict that in advance. Generally, we've always seen that when markets deliver much higher returns than the long-term returns of 12 to 14% that one has seen over 30 years, is a time to be a little bit cautious and moderate your return expectation. So we encourage more investors investing in India because penetration of equity as an asset class, equity is nothing but growth, is far lower. And thanks to various efforts in the last few years, more and more investors are embracing this journey. In this, there are two sets of investors. One who will be very long-term in nature, who are investing through SIP and disciplined asset allocation. They will generally benefit from the long-term growth as well as intermittent fluctuations. And there will be some short-term investors also who have to then rely mostly on luck that, okay, if this year also the same run of last year repeats, they should be happy. But we should be ready that, one can have moderation of returns because we've already seen a sharp run up. Valuations have, crossed certain threshold average numbers. And many pockets of the market, especially small and mid caps, do look expensive because more money is chasing less number of stocks.
Exactly. I was, in fact, just coming to that point of moderating your expectations for mid-cap and small-cap, everything always is not shiny and rosy in the market. And as far as mid-cap and small-caps are concerned, how do you moderate your expectations over here? Because you've seen a superb run-up. Time to look towards large-cap. What is your view on this and what is your house view on this?
Yeah, our house view is reflected in our conduct. And last month when we launched our small cap quality index fund, we came with two nuances. One, it eliminated almost 70% of the portfolio, which was scoring poorly on the quality of business, on ROE, on leverage, on governance, on beta of the stock price, so on and so forth. So it only selected 50 companies out of the universe of 250. So quality becomes very important at points in time like today, when overall small and mid caps have become too popular and too exuberant. The second thing we did is we launched it as a SIP focused NFO, so that we encourage investors not to put money in lump sum but invest via staggered SIPs of 10-20 years. As we speak today, we have launched a multi-cap NFO, and the reason being that at least there we are again saying that instead of 100 rupees in small and mid cap, where most of the money is right now going in, 50% of the portfolio will be large cap. Some part of the portfolio may even have some global stocks of solid quality, but available at reasonable price. And again, a SIP recommended or a SIP focused NFO. So this is a reflection of our view that these are times to respect. And in just 2 months back, we did a multi-asset allocation fund, where again, the idea was to add extra asset classes like gold and fixed income and global equities, so that the investor is not only embracing one type of risk of what has done very well in the last 18 months or so. So as a house, we believe these are times to invest through SIPs, and these are times to add more large caps in the portfolio. And these are also times to add another asset class like fixed income, where yields have risen over the last 3-4 years. And we see signs of stabilizing of interest rates. And maybe over the next 2-3 years, if interest rate cycle turns, there may be marginal gains to be made there as well.
Sectors, in fact, if one wants to initiate a strategy where they want to do some sector picking. But then before that, I want to I want you to explain our viewers, because 2024, given the amount of experience you have in the market and in the business, Kalpen, help us understand how different, or even if it is different or not. I mean, you've got to choose that line. We have the interim budget coming up now. We have elections coming up. How different do you think is 2024 historically? We talk about markets, or we talk about world economics, or India growth story.
The India growth story is only becoming more relevant because multiple points, multiple parameters are coming together. So the macro data points for India look stable. The fact that it is still, 50 to 60% of our profitability comes from domestic sector, domestic consumption, and does not have significant impact with the vagaries of the world outside, also to some extent gives us comfort. Relative to the rest of the world, our growth rates are, better. Flows from domestic investors are rising to a large extent, and incrementally now flows from global investors are also coming back to India. So all the tick marks that are required for a stable outcome are in place. The only variable, because all of this is coming in place and more flows are chasing companies, is that the asset class of equity, if it should be, let's say, priced at 100 rupees from a value point of view, is getting priced at 110 or 115, depending on sector to sector and company to company. So probably valuations are reflecting 1 or 2 years of return already priced in, and there is no room for any disappointment. Now, if the story continues, if companies continue to execute and profitability keeps rising, I think the journey will be stable. But the last quarter, we published a document called the report card, half-yearly scorecard of companies, that showed that revenue growth for corporate India was up by around 4 to 5%, whereas profit growth was up by 18%. Now, we can draw two inferences from this: that profitability is remaining intact or rising because raw material prices have come down and margins have improved. Commodity prices have come down, but the volume growth is not very high. The volume growth has now moved to single digit, and that can be a sign of worry. So we have to wait and watch over the next 4 quarters how these numbers play out. Apart from that, not just India, there are many parts of the world which are going into election, and there will be some bit of turmoil in lines that there can be changes. But in India, broadly, it seems to be consensus that the same regime comes back, and stability remains intact, and hence it should not be a matter of worry for investors, according to me. Election is not a matter of worry, according to me. If at all something is a matter of worry, it is global geopolitical issues and how global flows move. And because we are relatively more expensive than some of the other emerging markets, if flows decide to turn to some extent, that could be a matter of worry, and that can lead to intermittent volatility of 10 to 20%, which happens every 18 months or 2 years, election or no election. So that is a feature of the market. It is not a bug of the market.
Kalpen, I know you don't talk short term, and you don't talk about trigger specific strategies, but then we also have our viewers who would like to initiate something for maybe a medium term outlook. So considering election as one of the triggers, what could be a sector play that they can opt for or strategize in their portfolio?
I only don't talk short term because I think it's more like a coin toss, and more often I lose the toss. But still, since you asked that question, if you look at what is our conduct, again, if you see most of our portfolios, we have a higher tilt towards banks and NBFCs, basically the BFSI theme. In fact, which is why last month we launched the BFSI fund. So normally, wherever we see that the sector has consolidated or margin of safety has improved or future prospects look better. So BFSI is a sector we like because the sector has got cleaned up over the last 5-6 years. Credit growth gradually has started picking up. Valuations have come down significantly in the last 3-4 years because many large banks have actually not seen price appreciation, whereas their book values have risen or their profits have grown at 15 to 25%. So that is one large pocket in our portfolio. We also have a large overweight in the healthcare sector. So just to give an example, in our large cap fund, if Nifty or the top 100 stocks have a 4 or 5% weightage to healthcare, in our portfolios we have between 10% to 16% weightage to healthcare as a sector. So these are two dominant sectors that we have in our portfolio. And apart from that, a little bit of auto ancillaries and the manufacturing space. So broadly, that's our largest two weights or overweights are banking and healthcare. Healthcare to some extent has gone up in the last 3-4 months, but they still remain. We've been booking some profits there, but they still remain a large part of our portfolio.
All right, I have to really wrap up this discussion, but then before I let you go, what is your 2024 resolution or maybe your financial resolution if you have any?
Stay invested. That's it. Simple.
Thank you so much for being on the show today, Kalpen Parekh. Thank you.
Bye. Good day.
On that note, let's slip into a quick break, but then post that, let's get your mutual fund portfolio queries answered. And before that, I'm going to also flash our WhatsApp number, just in case you want to send us your queries. Anything related to your financial portfolio, be it mutual fund, insurance, tax or loan, we have our WhatsApp number, which is 8657974571. And we also have our email ID where you can send us your question, themoneyshow@etnow.tv. So a question answer session where our experts would be answering or giving you solutions for your financial portfolio after this break. Welcome back. You're watching The Money Show, and there are a plethora of funds available in the market to invest your hard-earned money in. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? Today I have with me Hemant Ustigi, Wise Invest. Also, do not forget to send us your queries on our WhatsApp number, which is 8657974571. You can also email us your queries on themoneyshow@etnow.tv. Hi, good evening, Hemant, and welcome to The Money Show. And as we begin, we have the first viewer online, Aditya Vasudevan. Hi, Aditya. Good evening. How are you doing today?
Hello, ma'am. Good evening. I'm good. How are you?
I'm doing good. Thank you so much for sending us your question, Aditya. So, you have a corpus of 4 crores that you want to deploy, right?
Yes.
Sure.
I'm looking
And,
for an
that-
alternative to fixed deposit.
Alternate for fixed deposit because you can't take risk for this money. And I think the period for investment is also 2 years.
Yeah.
All right. Right now, what all investment instruments do you have in the portfolio?
I'm invested in mutual funds across different.
You
large
have
cap,
mutual
small
funds.
caps and
Okay,
flexi caps,
sure. Sure. All right, Aditya, we are going to help you with this today. And let's go to Hemant. Hemant, 4 crores and safest investment instruments for 2 years.
Well, Kavita, I think there are two important aspects. One, the time horizon is 2 years. And second, he has made it very clear that he's looking at a very safe investment option, which can be an alternate to the fixed deposits. So I think there are limited options in terms of that, because let's not forget that mutual funds are market-linked products. So any product that you invest in, there is going to be some amount of volatility. So I think it's important for him as an investor to understand the attendant risk of volatility for certain periods. There are 2 categories of funds I think you can consider. One is the short-term debt funds. Okay, because that will actually suit his time horizon. So there are a few funds that you can consider there. One is Bandhan Bond Short-Term Fund and Nippon India Short-Term Fund and ABSL Short-Term Fund. The second option, and I think let me also highlight here the fact that the taxation of the returns on the short term is going to be exactly the same which is there for fixed deposit, which means that he will be paying tax on the entire amount at his applicable tax rate. Another option where, which is again quite safe, I would say, but I think the returns are more tax efficient is the arbitrage fund. Now, arbitrage fund is the fund basically that try to generate return from from investing in spot market as well as the future market. So for example, if they buy in the spot market, they sell it in the future market. So there is no open position in equity. I think that again is an option, a very good option that can be considered. And the best thing about those is that the taxation is of equity, which means that after 1 year, when you take out the money, you end up paying, capital gain tax at 10%. So for any investor who is in the high tax bracket, I think arbitrage fund can be a great addition. So there are again a few funds: Kotak Equity Arbitrage Fund, SBI Equity Arbitrage Fund, and ABSL Equity Arbitrage Fund. Since he's investing 4 crore, maybe he can divide it over 2 or 3 funds.
All right, quickly, Aditya, are you there on the phone line with me? Do you want to ask anything else?
Yes, ma'am, I'm clear about it. I got it. I got the answer.
All right, all the best. And I think with that, it's time up, Hemant. Today we could just take only one question. But thank you so much for being on the show and helping our viewers with their financial portfolio queries. And before I sign off, I'm going to leave our viewers with our WhatsApp number and email ID, where we keep waiting for your portfolio queries. WhatsApp number where you can send us your question in detail, 8657974571. Email ID, themoneyshow@etnow.tv. Also, you can watch us live on our social media platforms. In fact, even on YouTube, you can send us your question. Leave your queries in the comment box, and we will include your questions in the show. Thank you so much for watching. Goodbye.